How do I? Okay, cool. So this is the little black book about money. Ooh, okay, let's start again. This is the little black book about money by Michael Harding, breaking down the basics of tax, saving, and investment. What you need to know, but they don't teach. Financial literacy for beginners. So, disclaimer, I am not a financial advisor, neither do I claim to be one or intend to come across as one. My aim is to share information and my individual results and methods that led to said results. Please do your own research. Our content is intended and should only be used for informational use only. I can direct you to an accredited professional financial advisor. Her name is Victoria Navarro. It's very important to do your own analysis before doing any or making any investment based on your own individual circumstances. All investment comes with risk. If you're unable to mitigate your risk and understand your individual financial circumstances, you should take independent professional advice from a professional advisor, or independently research and verify all and any information you may find in our book that you wish to rely upon, whether you wish to make an investment decision or otherwise. So firstly, what is money? How can we make something when we don't even understand what it is? Now, the first things that people often think about money is where they think it's just money. They just think it's, the question is not even that. The question is to ask yourself, what do you think money is? Because unfortunately, we're not actually taught it by the current education systems. We're left to just figure it out for ourselves. Now, the true meaning of money is it's a medium of exchange, a method/tool for capital growth, and a method/tool for wealth preservation. Now, the problems is the fact that they don't teach these things in school. So I've highlighted some of the things they don't teach in school. They don't teach how a mortgage works, how to pay taxes, stock market basics, how to buy a house, how to earn money renting, how to build an email list, how to buy shares in companies, what interest rates mean, how to write a CV, what dividends are, how to build a personal online brand, how to sell products online, how to think with a long-term mindset, how to budget, the benefits of a credit card, and how to use a credit card properly. Now, we're not going to go through all of these things, but we're just going to go through some of them. And target one is to understand. And the most important part of this whole thing is that you take action. So number one, we're going to address the problem. The number one problem is that people just don't understand anything about money, and they're not using their money effectively. Now, most people blame, 59% of people blame that there's a lack of resources, that they don't have enough money to invest, which now with the current climate with fractional shares, you can invest for as little as £1. Next is 39% of people say there's a lack of knowledge that holds them back, whereas most of the information is actually readily available on the internet. Now, ultimately is the fear of failure. 34% of people feel that they're afraid of losing everything that they invest. Now, the problem with this is that all these factors culminate in an insufficient investing. In fact, 50% of the 26 trillion European wealth market is currently uninvested cash earning zero interest. So that means that there's over 13 trillion just sitting there that could be being invested into companies and into people, making the world just so much more of a better place. Now, number one, UK money is the number one cause of stress, ranking higher than physical health, work, or family. So we can see not understanding about money actually genuinely affects people. When people begin investing, they see immediate emotional benefits compared to non-investors. Investors are 16 percentage points happier, 23 percentage points more positive about their well-being, and 20 percentage points more fulfilled. However, only 37% of Brits hold market-based investments. So why is this even more of a problem? We can see that according to BlackRock Investor Pulse in August 2018, only 3% of the UK population is actually receiving financial advice. Now, a main contributing factor is the shortage of financial advisors, but it still means that there's only 2.6 million people in the UK receiving financial advice. And that would mean that on average, the average financial advisor can see around 100 clients each, because there's 26,000 financial advisors, which leaves 51 million people without financial advice. And most of these financial advisors ask that their clients have £50,000 in the bank at a minimum, and require on average around £150 an hour. So the ultimate problem with money is the mindset. This chapter is to help educate and provide new perspectives on the mindset and beliefs about wealth and money. So first of all, we're going to go over the core concepts. So money is a token or value of energy exchange, not time. We pay for the value you bring to the marketplace. To create more money, deliver more value to the marketplace. So an example is a bar of iron costs £5. A bar of iron made into a horseshoe is now worth £12. That same bar of iron made into needles is worth 3,500. That same bar of iron made into balance springs for watches is worth 300,000. So your value is determined by what you are able to make of yourself, or what you're able to make of things, and what marketplace you deliver them to. So you can have the exact same skill set, but if you're delivering it to an inefficient marketplace, then you're not going to get the equivalent value that you should be receiving, no matter what it is that you're doing. If you're a chef, if you're a plumber, if you're a footballer, if you're an artist, no matter what it is, you need to make sure that you're delivering your value to the correct target audience. So one of the things that we just want to quickly touch on is how to create money. Now, money is created by offering solutions to problems. If you identify a problem and then find a solution and share that solution to as many people as possible, that's how money is generated. This is why Microsoft is one of the most valuable companies on the planet. Why? Because they've solved a massive solution, which is word processing. They've solved a massive solution, which is helping people to create spreadsheets. Say, for example, Amazon, they've solved a massive solution helping people to get the products that they want. Apple, they've helped people to get mobile phones. So you can see people are trained to believe that money is bad and that people that billionaires are bad, when in fact these are the people that are bringing more value to more people. Just ask yourself, these biggest companies in the world, Microsoft, Apple, Tesla, how many millions of people across the planet have what they've done affected right now? And you'll see that the answer is well in the millions, perhaps even billions. Therefore, that's why they're making billions. So the fundamentals, the first law of wealth is to keep a part of all you earn. Save at least 10% of your income. Now, the second law of wealth is to put those savings to work and invest it so it will multiply. What most of us do is we think that just saving money is the right thing to do, when in fact it's actually making that money that we're saving go to work for us. The third law of wealth is to avoid debt. So the poor people pay interest while the rich earn interest. The fourth law of wealth is don't speculate and get rich quick schemes. Invest in a solid business that is a long-term plan. Most money that leads to wealth is slow money. Now, the fifth law of wealth is invest in yourself. Gain knowledge and keep improving your financial literacy. To improve anything in life, you need to learn more. Now, especially when it comes to the finances and financial literacy, we're not taught it in school. And then what makes it even worse is people aren't continuously learning about it once they get out of school. Now, the sixth law of wealth is to safeguard and growing your fortune with diversification, because anything can happen at any time. So it's important to not have all of your income coming from one place. Now, let's touch on that a little bit. That's like having a table. If you've got a family to support or people to support, having only one leg to support that table, if that leg breaks and that income stream collapses, then you're in a position whereby you now can't provide an income. Multiple legs to support the table, it means that if one leg breaks, the table will wobble, but it will still remain standing. Think of your table as your life and the legs as your income streams. Set yourself up with multiple streams of income so that your life doesn't collapse if one fails. Now, again, we want to think of money in a different way. So let's say, for example, you go out and you buy a shirt and it costs £24 and you get paid £8 an hour. You're now wearing 3 hours of your life. Let this change your outlook on money. Let's change it even more. Let's say, for example, you go out and you buy yourself a nice Gucci or Prada t-shirt or whatever it is for £240 and you get paid £8 an hour. That's now 30 hours of your life that you're wearing. Cool. So the fundamentals, one of the most important things to learn in school is actually something called the cash flow quadrant. So the way that the cash flow quadrant works is about explaining the different ways that money is actually made. Now, money is actually made in 4 different ways. The 4 different ways that it's made, let's split them up into 2. So the way that we're going to split them up into 2 is active income and passive income. So active income is where you're trading your time for money, and this is what most people are doing. This is what 95% of the population is doing, and they have no time, but they do have an income. Now, the next is where people own a job. This is where people have a small business. And again, this business is relying on them to turn up to actually generate that income. Now, the next is people where people have a passive income. So this is business owners where they have a system where people work for them. So say, for example, if they own a business like a McDonald's or a Starbucks or something like this, it means that they don't actually have to be there and the business will still make money. So now they have money and time combined. Now, the next is where money works for you. This is where you're an investor. And this is where you've just taken some money, pull it into an asset, it's grown and generated an income for you. Now, to really understand this, what we have to understand is the difference between assets and liabilities. Now, the middle class and majority of people, we only have one source of income, and this is our job. Yet we have multiple expenses, and this is our liabilities. This is the money coming out. We have our mortgage payments, our car loans, credit card payments, and student loans. Whereas the rich, what they do is they have multiple income streams, and they try to have as more income streams than they have liabilities. This creating more and more income for them. So they have rental income, dividend income, interest income, royalty income, their assets that they have real estate, stocks, bonds, and intellectual property. And then they only have as little liabilities as possible. So it's just a game of what comes in versus what's going out. Now, the fundamentals, what's more powerful? 10 minus 10, 10 plus 10, or 10 times 10. It's the same numbers, but they get different results. Now, in school, we're only unfortunately taught about one way of making money, and that's earned income. Now, in fact, there's 8 different ways of making money. First one is income from working a job and exchanging your time for money. Number 2 is profit income, income from buying and selling. Literally, you could buy a pair of shoelaces on eBay, sell them again on eBay for a little bit more money and make a profit there. One of the things that I encourage people to do is go to Poundland, find some items, go to car boot sales, find some items, and then sell them on eBay for double or triple the price. Interest income, income from lending money. This is what banks do. Capital income with and interest income, you can do it yourself as well, which we're going to teach later on. Capital income is assets increasing in value. Dividend income, income from owning stocks. Rental income, income from renting a property or item. Royalty income, income from using someone using your idea. And residual income, when you continue to get paid on work that is already done. So an example of how money works is, and compounding income is something that I want to show you here. It's the story of the magic penny. Would you rather have £1 million or a penny that multiplies by itself 30 times? Now, the first time I saw this, I liked the idea of getting £1 million. Now, what actually happens, what I want you to do is to get a calculator and enter 2 times 2, 29 times, and see what number you end up with. This is called compounding, and what you can actually get money to do for you. So again, one of the key things that we want to do is we want to change our perspective in the way that we look at money. So there's 52 weeks in a year, and here's a way to look at it. If you make a little bit of extra money every single week, it can make a substantial difference to you. Most of us shun the idea of making £25, £50, an extra £100 a week because we think that it's too small, but the compound effect of it is quite dramatic in comparison to the average promotion that most people are actually getting. So you can see an extra £25 a week is 1,300, extra £50 per week, 2,600, extra £100 a week is an extra 5,200. Now just ask yourself, are most people getting a promotion of £5,200, especially in the current climate? No. But can people make an extra £100 a week? Yes. So it's better to find a permanent income than to be fascinating. So the most important part now is the percentages. This is a number that you'll see. This is a sign that you'll see absolutely everywhere, but it's not taught to us how it actually works. So wealthy people count their money in percentages. They don't look for more hours or another job. They find ways to get money to work for them, mainly putting their money to work in the biggest companies in the world. And using the quote Jim Rohn says, wages will earn you a living, but profits will make you a fortune. So let's break this down. So if you have £100 and you get a 10% return, that's £10 profit. You now have £110. If you have £100 and get 100% return, that's £100 profit. You now have £200. So if you have £100 and get 500% return, that's £500 profit. You now have £600. Imagine you can make money work for you like this whilst you're at work or at home. Guess what? That's exactly what the banks and most pension funds do with your money whilst it's there. But guess what? You can do it too. So what is inflation? It's the rate at the prices things go up. So with 3% inflation on the price of things, you can see slowly you get less for your money. This is why it's essential for you to make money work for you. So here's some examples. Let's say, for example, a chocolate bar is 30p, a train ticket is £30, rent is £300, a car is 30,000, and a house is £300,000 in 2010. If the inflation rate is 2% a year, here's what happens over 10 years. So we can see, first of all, the chocolate bar starts at 30p and ends up being 37p. The coffee ends up being £3 and ends up being £3.66. The train ticket starts at £30, ends up being £36.57. The rent starts at £300, ends up being £365. The car starts at 30,000, ends up being 36,000. The house starts at 300,000, ends up costing you 365,000. So we can see what happens here when people go to buy a £300,000 house or £30,000 car, and they're paying just an extra 2% interest every single year. You can see with the car, you're ending up paying an extra £6,000. With the house, you're ending up paying an extra £65,000. Now, let's say for example, you inherited £400,000 and you plan to buy a house and a car. The car at 30,000 and the house at £300,000. 10 years later, if you waited, your £400,000 is now worth £70,000 less. So what happens if your income doesn't increase with the inflation rate, or if the money you have in the bank or save doesn't have a high annual percentage rate than inflation? Can you see how your money is worth less and how and why things seem to get more difficult? So we can look for yourself. If you just go on Google and type in annual inflation rate UK, we can see that the average inflation rate is around 2% and a little bit higher. So this is the average rates that you're getting from most banks. This is from some of the best banks in the world. We can see that this is much lower than the inflation rate. So this is how APR works on a credit card, and how high APR can get you in a lot of financial difficulty, as some APR is 50% or even 500% in extreme money lending and payday loan companies. So most banks offer a 1.5% annual return on an ISA if you're lucky, 3% if you're really lucky, 6% is considered phenomenal, 12% is almost unheard of and tends to be only the funds offering annual returns similar to this. You can make money like the banks if you know how and where to invest your money. So let's say, for example, here, £10,000. I don't even know if it was recording the last one, but we'll see. Okay, cool. So the game, a beginner's guide to investing. Every day you wake up to the alarm on your Apple iPhone, shower using Procter & Gamble Head and Shoulder shampoo, drive your Tesla to office, logging into your Microsoft computer while sipping Starbucks Light. You mean to tell me you're not investing in any of them? Now, most of the time in most of the world, we are kind of fed this story and this belief that property is the place where we should be investing, and it's the safest and it's the best investment ever. However, when we look at the top 10% wealthiest people in the world versus the bottom 90%, majority of the 90% of the bottom 90%, the majority of their wealth is derived from their homes. When we look at the top 10%, the vast majority of their income is actually generated from stocks and mutual funds. So would you want to do what the bottom 90% of people are doing in terms of financial wealth, or what the top 10% of people are doing? And when we look at and break it down even further, let's have a look at the actual returns, the facts over the last 20 years. So we can see the National Home Price Index in America. The UK one would be lower than the American one, in fact. We can see that since 1990 to now, it's about 200% return. Whereas the S&P 500, which is the top 500 companies combined, this is just an index fund as well, would return around 900% in the last 20 years. So that's either doubling your money and a bit, or getting a 9 times the return on your money. So that's the first bit of information there that we want to really think about and digest. So one of the things that we always hear about and we always see is that the rich get richer and the poor get poorer during financial and economic downturns. And why is this? This is again because the rich have their money invested in the right places, in assets. Yes, they do have property, but they have money invested in property in a different way than what most people have, which we're going to get into. So we can see during the US pandemic, the global pandemic, what happened in terms, but we're going to break it down. So the total US billionaire wealth went up 34.2% this year. In terms of the top 5 billionaires, we can see that Jeff Bezos, his income went from 113 billion to 182 billion. That's 61%. Elon Musk went from 24 billion to 126 billion. That's 413% growth. Show me any property that's going to do that. Bill Gates went from 98 billion to 119%, 21%. Mark Zuckerberg, 54